So we reached the point where we have to get into the prorations and how we do it, right? Not everybody's going, it's not going to ever be clean, right? It just can't be by the nature of the calendar. Okay, so we're going to close on different days. Now, remember what we talked about earlier. We said that every month is going to have 30 days and every year is going to have 360 days, right? 12 months of the year. That makes it all work out. Regardless of how many days the calendar says, that's what we're going to do going forward, at least for the for this class's purposes. Okay, so 30 days, 360. All right, so let's go back to where we were. All right, so let's go through this now. All right, I want to make sure you understand it. So when the buyer and seller go to closing, there are 3 different ways this can go to closing. All right. So taxes get a lien every January 1. All right. January 1st, tax lien. All right. If we sell before before September 1st, we cannot pay the taxes until September 1st or later. Okay. So they can't be paid prior to September 1st. So I want you to see this example here, all right? On January 1, 2016, all owners of real property had a lien attached for their property for their, this should be 2016 property taxes. Owners may begin paying their bills on September 1st of 2016. Each owner has until January 5th, 2017 to pay their 2016 real property taxes without any penalty or interest, okay? So we have the calendar down. We're pretty straight for that. All right, now we're going to have to do some prorations, what we call prorations, all right? So it says if a property sells prior to September 1st, taxes are usually unpaid because we can't pay them. When the bill is mailed, it'll go to the property. Since the property has sold, a new buyer will receive the bill for the entire year of taxes. Is it fair for the buyer to pay a year's worth of taxes when they've not lived in the property for the year? Obviously not. So the bill is going to continue to come to the property. Doesn't matter who owns it. The tax bill is the tax bill on the property. It's going to get mailed to that same address. All right. So what we have to do is figure out the date of closing and how many days the seller has owned it before we transferred the property. He's got to pay for it, okay? Now, the seller owns the day of closing, okay? And that's going to be really important. Seller owns the day of closing, okay? With one exception that we'll talk about later in interim interest, because the bank's not going to let the buyer slide for a closing day, right? Bank's going to charge him for something. But for everything else, the seller owns the day of closing, all right? So we have to figure it out, all right? Seller is going to be responsible for paying the taxes through and including the day of closing. The closing attorney will take the annual tax amount, divide it by the number of days in the year, then charge the seller for the time they've lived in the property, all right? So let's take a look at that. We're going to take the total amount of the tax bill, all right? We're going to divide it by the number of days in the billing period, 360 days, right? That's going to be for the annual. And then we're going to take that 360 days, because that's going to give us a daily amount. How much per day were the taxes, right? We divide it by 360. And then we're going to figure out how many days the seller owned it and multiply it by the daily amount. And that's going to give us our prorated amount. All right. So the seller is going to be responsible for paying the day of closing. So let's look at the example. Taxes for the year are $1,200. The year total, right, $1,200. The property is closing on February 10th. The seller will be responsible for taxes from January 1st to February 10th, which is 40 days, 30 in January, 10 in February. How will the taxes be handled at closing? So here's what we're going to do. We're going to take the annual taxes, $1,200, and we're going to divide them by 360. How many days in a year? We need a daily number. We need a daily figure. And that's going to be $3.33 per day. all right, per day times 40 days. January, 30 days, 10 days in February, 40 days. So that means that $133.20 is going to be the seller's cost for the taxes for that year. So the seller's got to pay, he's got a debt that makes it a debit, right? Because the taxes can't be paid before then. So the buyer's going to get the bill. So that means that the seller's got to give the buyer some money when the bill comes in. He's going to have to pay it. At the closing, they're going to collect it. So the buyer's going to get a credit for that money. And then when the bill comes in, the buyer pays the whole thing, okay? Because he got his money up front, all right? So in this example, the seller will owe $133.20 towards the $1,200 tax bill. The closing attorney will debit the seller and credit the buyer at closing. All right. Person who pays has the debit, person receiving his money has the credit. All right. And it just makes it fair. Okay. All right. So let's look at another one. Let's change the scenario. All right. If my property is closing December 15th and the seller's already paid the taxes for the year, does the buyer get off scot-free for the end of the year? No, no. So what we're going to do is take that same $1,200, right? We just change it a little bit, and we divided it by that 360. So we happen to be using the same formula. So $3.33. So the seller, they closed on the 15th of December. So the buyer's going to owe from the day after, the 16th to the 30th. 16th to the 30th for 15 days. So $3.33 a day times 15 days. The buyer, right, has to pay $49.95 to the seller. Seller gets a credit for it, buyer debits it. Seller's just getting his money back. He paid it. Buyer now has to pay the seller back. So that's how we do it. All right. Okay. The tricky one. If the taxes are unpaid and we are after September 1st, both are going to pay their fair share at the closing, and we're just going to wipe out the taxes for the year. Okay. So, for example, taxes of the year, $1,200, same deal. All right. Property closing on October 30th, and the taxes are unpaid. The seller will be responsible for the taxes from January 1 through October 30, 300 days. Buyer is responsible for taxes from November 1st to December 30, 60 days. Okay. How are they going to be handled at the closing? Same thing, $1,200 divided by 360. We just happen to be using this $1,200. Believe me, it changes. That's going to be $3.33 a day. The seller's got to pay 300 days. That's what he owed it for. So he's going to be responsible for 300 days times 333, $1,000. Now, the easiest way to figure out the buyer's share is take the total amount, right, which is $1,200, and subtract what the seller's going to pay. That leaves what? $200 for the buyer. So both will be debited. Okay, both will be debited. The seller will be debited $1,000. The buyer's going to be debited $200. And they're going to give it to the attorney. The attorney's going to pay the taxes. Stick with me. Stick with me. This stuff is like important. A property, this practice tax proration problem. A property is assessed at $160,000 and is closing on February 15th. With a tax rate of $1.10 per 100, how will the taxes be handled at closing? Okay, very important. Let's look at this. So we have how many days? So we have January, which is going to be 30, and we have February, which is going to be 15. So that means we're looking at 45 days. Anybody disagree? All right, we're good. All right, so we have 160,000. We got to figure out the taxes first. They didn't give us the taxes yet, so we got to figure that out, right? So this is going to be, we're going to move this decimal over 2 places, times 0.0110. Everybody happy? Everybody get that? Right? So that means that we are going to be at 1760 for the year. Right? 1760 for the year. We're going to divide that 1760 divided by 360, because that we need the daily rate, is going to be 4.889 a day. Right? 4.889 a day. And how many days? We got 45 days. He owes us for 45 days. And he's going to owe $220. So he is going to be what? Debited, seller, buyer, credit. Right? Debit, seller, buyer, credit. At this particular point in February, there's not much you can do other than give the buyer some money, because we can't pay the taxes until after September anyway. It's not like you can collect the money, right? You only got to move money here so that the seller gets it. Did everybody see what I just did? We figured out the taxes for the year. We divided it by 360 days. We got a daily rate. Then we figured out how many days the seller owned it. All right, how many days the seller owned it. And then we multiply it by our daily rate. When you think about it, it's really pretty straightforward. Not too many tricks. All right, so we want to take a look at that. All right, let's look at practice problem number 2, and I'm going to let you do number 2. Okay. Property is assessed for $350,000 and is closing on December 15th. Taxes have already been paid with a tax rate of 75 cents per 100. How will they be handled at the closing? How will they be handled at the closing? Okay, just telling me seller and buyer, please add, is it going to be a credit or debit? You're going to need to know that, because you're going to end up with the same thing, and it's going to, the questions are going to say, is it a debit or a credit? So if you're telling me 2405 and then you're giving me like buyer or seller, I need, is it going to be a debit or a credit? All right. If we're paying it, it's a debit. If it's collecting it, it is a credit. Okay, I got answers all over the place, but let's see. Let's walk our way through it. All right, let's walk our way through it. Okay, so the first thing we have to look at, we got an assessed value of 350,000. All right. And we got a closing on December 15th, which means the seller owns through December 15th. Okay, so we start on the 16th. That's when the buyer's first day of taxes are. Taxes have already been paid with a rate of 75 cents per 100. How will they be handled at the closing? Okay, so 350,000 times our tax rate. All I did was take that 0.75 divided by 100, move the decimal place 2 over. 2625 is our annual taxes. We took our annual taxes and divided by 360 days. We need a daily amount, 7.291 a day. Now, you could have taken that 7.291 a day and multiplied it by 345 and then subtracted that number from 265 and come up with this. But isn't it so much easier to just figure out the last little bit of the year, right? Same deal. So from December 16th to the 30th, it's 15 days. Remember, every month has 30 days. So 15 days times this 7.291 means that we got $109.37 of this money goes back to the seller as a credit. So we have a buyer debit, seller credit. Can you say what the difference was? Seller gets this money at the closing. He already paid it. He paid the taxes September 1st, paid it. We closed on December 15th. Well, the seller doesn't have to pay the whole year. The buyer has to pay that little bit. So the buyer's giving him his money back for those few days that he already paid. So that's why his seller's getting a credit. The buyer's have to pay for it. Documentary, right? He's going to have to pay for it at the closing. He's going to have to pay it. So that's why it is a buyer debit, seller credit. Right? Now, anything September 1st or beyond or before, September 1st or before is going to be a seller credit, buyer debit. Okay, because they can't pay them until after September 1st. So if we close in March or we close in April, the seller is going to give the buyer a debit, and then the buyer is going to get a credit for that. Okay. So yeah, because the September 1st thing is what is the timeline. All right, so you got to remember this. You're going to get 3 or 4 questions on this, and then additional questions on proration. So you're going to have to get the flow of this. All right, you're going to have to get the flow of this. And debits and credits are not going away. You're going to have to know those. Okay, I know it's new, so that's okay. That's what we're working on. That's why we're spending time to do it. All right. Okay, so the first one was before September 1st. The second one was after September 1st, and the seller already paid it. The third one, number 3 here, says that closing is set for October 30th, and the taxes will be paid at the closing for a property in county assessed at $65,000. All right. So go ahead and figure out the rest of this. All right. How are the taxes going to be handled at the closing? How are the taxes going to be handled at the closing? The taxes are going to be paid at the closing. They're going to both give them to the attorney. We have a closing set for October 30th. All right. The same closing set for October 30th. Taxes will be paid at the closing for the property in a county assessed at $65,000. The city rate is $35,000. Do we need the city rate? We don't need it, right? Because we're in the county. All right. So the county tax is 70 cents per 100. How will the taxes be handled at the closing? Okay. So if we're closing on October 30th, that means that the seller is going to owe for 10 months, 10 times 3, right? 10 times 30. So he's got 300 days. And the buyer is going to have to pay for what? The balance. 60 days? That's how they got to pay it. Okay? Everybody see that so far? All right? Straightforward. All right. So now we have to figure out the taxes. So we're assessed at $65,000 and times 0.0070. Is that confusing anybody? Okay, I want to make sure, I don't want to confuse anybody by just doing that. All we're doing is taking that 0.70 and divided by 100. That's it. That's all we're doing. I'm just moving the decimal point. All right. So 65,000 times 0.0070 is going to be $455. That's going to be our annual taxes. We're going to take that 455 and we're going to divide it by 360 days. So that means I got 1.264 a day. Okay? A day. So we already have the breakout. So I have 1.264 times 300. And I have 1.264 times 60. All right. This is the seller. This is the buyer. All right. 300 days is 379.20. And the balance of the days, the 60 days, is going to be 75.80. Okay, 80. All right. Now, no city rate because we live in the county. That's what it says. This is going to be a seller debit. You got to pay. And this is going to be a buyer debit. You have to pay. We have to pay both right here at the closing. There you go. There you go. Okay, because they haven't been paid yet. After September 1st, the attorney is going to take the money for both. What's going to happen is this, and maybe you did, and we mentioned it earlier. Somebody asked a question. The North Carolina Real Estate Commission wants you to take all of your all your decimals, and keep them at 3 places until you get to the end. When you get to the end, then go down to 2 places. Okay. So when you're doing your decimals, just keep them at 3 places and round up the third, either up or down, wherever you got to go to, and keep them at 3 places. And then when you get to the end and the solution, then you want to round to 2 places, however that falls. Okay. So this is going to come with practice, and you're going to do. We're going to have a few practices after you do. You know, there's some here. There's going to be some in your questions for your in your homework. So you know, we're gonna be able to do all of those, and you're gonna have to do them in addition to all the others. Okay. All right. If it's before September 1st, the seller is going to get debited and pay the buyer, and the buyer is going to get a credit. If it's after September 1st and the seller is already paid, then the buyer has to pay the seller back. You would want your money back, right? If you paid the bill, you want some of your money back. So you want to get a credit as the seller, and the buyer is going to be debited. He's got to pay you back, right? And if it hasn't been paid yet or will be paid, both parties are going to be, if you're paying it, what is it? It's a debit, right? Both parties are debited, right? Why is it September 1st? I have no idea. Probably somebody's birthday. They decided it was a good day. I have no idea. Let's move on, all right? Because I want you to look at a couple of these multiple choice questions. Extra practice is what you're going to do here for homework, but we're going to do a couple more of these questions, all right? So page 5 and 6 in your math packet, so that's why you need to know where these are. There are a bunch. We're going to do a couple more here, but there are 7 questions here that are all multiple choice. But I wanted to, why is it important to know debits and credits? Well, look at the answers for number 2. You have 2 of the same numbers, but you got to know what debits and credits are, right? You got to know what debits and credits are. So you need to be able to pick that out, right? You need to be able to pick that out. All right. I'll leave number 1 for you. I want you to do number 2. I want you to do number 2. All right. Read the question because you need to practice reading the question and do what it asked you to do. All right. Do what it asks you to do and then come up with an answer. Then come up with an answer. I'll give you another minute. I want some folks that I see the same names here, but I see some that haven't answered yet, and I really need you to be part of it. So I want to see some different names up there. Yeah, there's no need to debit the buyer because we're closing on May 22nd. Buyer can't do anything yet other than collect the money and hold it until after September 1st. Right? All right, so let's look at what we got here. Okay. A house in the county selling for $175,000. All right, has an assessed value of $160,000. Do we need this $175,000? No, we don't care. Right? We're doing taxes. So our assessed value is $160,000. County rate 65 cents, city rate is 50 cents. Do we need that 50 cents? We don't need that either. All right. Closing is scheduled for May 22nd. How will taxes be handled at the closing? All right. So we have 160,000, right? Spread this out a little bit. 160,000 times 65 cents per 100, so that's 0.0065, all right? And that's going to give us 1040. We're going to take that 1040 and divide it by 360 days because we need a daily rate, right? And that daily rate's going to give us what? 2.889 per day. Okay. So now closing schedule for May 22nd, January, February, March, April. That's 4 full months of 30 days. That's 120 days. And then 22 days of May. So 120 plus 22 is 142, right? 142. So 2.889 times 142 days, all right, is going to be 410.24. Now, we have to do something with this. So the seller is going to pay, seller is going to be debited, and then the buyer is going to get a credit because he can't do anything at this point. Okay, he can't do anything at this point because he can't pay until after September 1st. If he could, he would, but he can't. So that's got to be your answer. So B is your answer here. Okay, B is your answer here. All right, let's do another one. So that was fun. All right, number 3. Go ahead and I want you to read it because I want you to practice reading those questions. All right, go ahead, number 3. Let's come up with an answer. All right, anybody who got B for an answer, I want you to go back and read the question again. All right, what do we got here? A house in the city has an assessed value of $190,000 and a market value of $210,000. Do we care what they sold it for? No. City tax rate is 48 cents and the county tax rate is 56 cents per 100 of assessed value. We're going to have to add those two together, right? So 0.48 plus 0.56, 14 is 104, right? Everybody agree with me? Good. All right. Closing is scheduled for October 25th, and taxes have been paid for the year. How will the taxes be handled at the closing? All right. So we need the assessed value, which is 190,000. All right, 190,000, and we're going to figure out times 0.0104. Does everybody see how I got that? I moved that decimal place 2 places over, right? Simply divided by 100. All right. So when I did that, I got 1976. That is my year's worth of taxes, right? My year's worth of taxes. So 1976 divided by 360. All right, divided by 360, 5.489489 a day. Okay. Now, the buyer's going to pay for the end of the year. He's got to give the seller money back. So he's got to pay for November. He's got to pay for December. So that's 60 days. And he's got to pay for the last 5 days of October, 26, 27, 28, 29, 30, right? So he's got 66 days, right? 65 days, sorry, 65 days. From the 26th to the end of the month, 65 days. So he's got 5.489 a day times 65 days, all right? So he's got 356.79. Now, and give or take, a penny is rounding, they got 77. Don't worry about it. All right. Now, look, if you're a penny or two off, I'm not too concerned about it. If you're $1 or $2 off, check your work. All right. So just an FYI. Now, so what do I have to do here? If I'm the buyer, I need to do what? The seller's already paid this. So the seller wants some of his money back. So I have to pay it. So it is a buyer debit. Seller gets his money back, seller credit, right? So in this particular case, it's going to be D, a seller credit and a buyer debit. Okay. All right. So if the a couple of things in the chat box, if the taxes have been paid for, then they calculate the remainder of the year after the closing date. Yes. Seller owns the closing date. The buyer's going to have to pay him back if it's already been paid for the balance of the year. Okay, at the closing. Right? So yes, absolutely. So if it says the county, you only pay the county taxes. If it says the city, you pay the city and county. Exactly. Exactly. If it says they live in a county, you just pay the county. If it says they live in the city, you pay both. You pay both, city and county. So let's see. So if the seller pays for the year, the seller gets the credit. Yeah. He's got to get, if we close before the end of the year, yeah, absolutely. He's paid it. He got to get his money back. There's no free lunch. Right? Nobody's getting anything for nothing. Does anybody know a taxing authority or a bank that's going to let anybody slide because they think you're a nice guy or a nice gal? I ain't found it yet, but if you know one, let me know. Right? I don't think it happens. How do you determine if the seller pays late? Well, they would collect that if the seller's going to pay late. And let's say we're going to close on January 3rd and he hasn't paid it yet. The seller's going to get deducted for the whole year of 2022, and he's going to get debited for the 3 days that he's got to give the credit for. The attorney will collect that taxes at the closing date. So anything before January 1st, they're just going to collect what he owes. So it'll be a double debit. So yeah, he's not going to get away with it. It's hard to get away with. All right, my friends. It was a good night. Hopefully I didn't stress you out too much. Don't worry about it. Keep doing the problems. You'll be all right. All right. Little steps. Good first night, right? So go ahead and keep practicing. We'll be all right.
If you like this video, feel free to share it with a friend. For more real estate education content, please subscribe to the channel. From all of us at Seacoast Real Estate Academy, thank you for watching.